If a country's economy is operating below the full employment level of output at a very low inflation rate, the central bank of the country is most likely to blink. For this question, we're told that a country is operating at below the full employment level of output, and we're asked to identify what the central bank of the country would do. So let's first model this in the aggregate demand and aggregate supply graph, where on the y-axis is the price level, and the x-axis is real GDP. And now if they're operating below the full employment level of output, then they're operating on the left side of the long-run aggregate supply curve. And now, for the central bank's actions, option choice A says pursue an expansionary monetary policy because it is required to do so by law whenever output is below the full employment level. This is incorrect because the reason given is wrong, as an expansionary monetary policy is the correct move, but not because it's required to do so by law. The central bank is not required by law to pursue an expansionary monetary policy. It does so to help fix the economy. So A can be eliminated because the reasoning here is wrong. B. Pursue an expansionary fiscal policy because it is required to do so by law whenever output is below the full employment level. This is incorrect because the central bank can't pursue fiscal policy because fiscal policy are actions by the government, not by the central bank. So B is incorrect. C. Lower the discount rate and buy bonds on the open market to generate an increase in output. So to analyze how this would influence the economy, we need to draw out the money market curve. So for this curve, the y-axis represents the interest rate, and the x-axis represents the quantity of money. Now, there are two curves for this graph. The first is a downward sloping curve representing the demand for money, and the vertical line represents the money supply, or MS. Now, lowering the discount rate would mean that the rate at which other banks can buy or loan money from the central bank is lowered, so they'd be inclined to loan more money. And because they're loaning more money, they would loan more money to people as well, and this would increase the money supply, which is good, because that would decrease the interest rate, and that would result in an increase in investment spending, shifting the AD curve to the right, and thus returning to a long-run equilibrium, which is what the central bank would want. And secondly, buying bonds. This is also good because if they were to buy bonds, that means they're giving money to the people and taking in the bonds. Because they're giving money to the people, they're adding money to the money supply, which will also result in a shift to the right in the money supply. And this would result in a further decrease in the interest rate. And because there's more of a decrease in the interest rate, there'll be more investment spending, and with greater investment spending, the aggregate demand will shift to the right, and returning to the long-run equilibrium. So overall, C seems to be the correct answer. But let's consider the other options as well. So, option choice D says lower the required reserve ratio and sell bonds on the open market to generate an increase in output. So lowering the required reserve ratio is a correct move because lowering that ratio means that the banks have to hold less money. Because they're holding less money, they can loan out more money, and as they're loaning out more money, the money supply will shift to the right, which is good because this will result in a decrease in interest rates and thus an increase in investments and a shift to the right in the aggregate demand curve. But selling bonds on the open market is the wrong move because selling bonds means that they're giving bonds to people and taking in money. Because they're taking in money, the money supply will shift to the left, which is bad because this would mean that the interest rates would increase. Because interest rates increase, the investment spending would decrease, and this would cause a shift to the left in the aggregate demand, which is not good because this would make the unemployment or the full employment or the gap between the equilibrium, short-run equilibrium, and the long-run equilibrium even bigger, which is bad. So we can eliminate option choice D because it highlights the move of the central government to sell bonds instead of buying bonds. So D is incorrect. E. Raise the discount rate and lower the required reserve ratio to generate an increase in output. So lowering the required reserve ratio is the correct move because that would leave more room for the bank to make loans, and with more loans, money supply increases, interest rates decrease, and investment spending increases. But raising the discount rates is incorrect because raising the discount rates means that banks would loan less money from the central bank. Because the smaller banks have less money to loan to the people, there would be a reduction in the money supply. Therefore, E is incorrect. And thus the correct answer is C.